One single ETF shifted 19.58% of its portfolio, not into tech, not into crypto, but into the one sector that just got full government backing under Trump's new $4.5 trillion Big Beautiful Bill. This shift told us exactly where the next big money is headed. And in this video, I'm going to break down exactly what's inside Trump's Big Beautiful Bill, how it's benefiting entire sectors, and the dividend ETFs that shifted their positions to reap the most reward. In the end, I'll show you and Josh how the ETF benefiting most from the bill could turn a $7 daily investment into a $1 million portfolio and pay over $7,000 per month in dividend income. But first, let's have a look at the bill that changed everything. Let's break down what's actually inside Trump's 2025 Big Beautiful Bill, because this isn't just another round of tax cuts. It's a full-blown economic reset that reshapes the rules of the game for dividend investors. The headline move is making the 2017 tax cuts permanent. That means lower personal income tax rates stay in place, and corporate tax rates remain at 21% instead of jumping back up. For companies, that's predictable long-term tax savings, and predictable profits are exactly what dividend investors want. Then there's the overhaul of business deductions. The pass-through deduction jumps from 20% to 23%, which means more profit retained by small and mid-sized businesses. Section 179 expensing limits doubled from $1.25 million to $2.5 million. In plain English, that means a business can buy equipment, machinery, or upgrades and write off the full cost in the same year, instead of spreading it out over several years. This encourages companies to spend more now, which often leads to faster growth and higher earnings. On top of that, 100% bonus depreciation is back. Companies can instantly deduct the full cost of big investments, like factories, large vehicles, or major upgrades, instead of waiting years to recover the cost through depreciation. Then there's the most targeted part of the bill. It clearly picks winners and losers. Oil and gas companies are getting fast-track permits and regulatory rollbacks. Renewable energy subsidies from the 2022 Inflation Reduction Act are removed, shifting the playing field away from green energy. Defense spending jumped sharply, with billions earmarked for missile systems, border technology, and military contracts. Infrastructure projects get a $12.5 billion boost, with specific upgrades like air traffic control modernization. In short, the bill rewards capital-heavy industries that can absorb large investments, generate big profits, and pay steady or growing dividends. If your ETF is overweight in these areas, you're positioned to benefit directly from the policy tailwinds. If not, you're likely to miss much of the upside. And one of them, just one, made that move before the bill passed. It rebalanced, refocused, and repositioned at the perfect time. Right now, most investors are celebrating the wrong thing. They see the headlines, tax cuts, more take-home pay, a consumer boost, and they assume this rising tide will lift all boats. But here's the truth. Not every stock benefits equally, and not every dividend ETF is built to capture what's really going on underneath. The problem is that many portfolios are still built for the last cycle. They're heavy in utilities, real estate, and big tech sectors that thrived in the low-rate post-pandemic environment. But rates are higher now, government spending priorities have shifted, and the industries with the strongest tailwinds are completely different. And that's the part people miss. This bill isn't designed to help the market. It's written to reward specific behavior. If your fund doesn't hold companies that are investing, expanding, and building within those favored sectors, you could be on the sidelines for the next phase of dividend growth. Meanwhile, the few ETFs that got this right are quietly pulling ahead. They adjusted, they reallocated into energy, defense, and consumer staples before the crowd, and now they're positioned to collect stronger profits and more consistent income for years to come. Most investors won't realize they've missed it until they see other people's portfolios growing faster, paying more income, and outperforming without taking extra risk. And by then, it'll be too late to reposition without chasing the rally. Which is why right now, before the rest of the market catches on, is the time to take a hard look at what you own. Because there's one ETF that's already made the shift, and once you see which one it is, the strategy becomes a lot clearer. So what is smart money doing right now? Let's be honest, retail investors are usually late. But if you want to know where the market is going, you follow the money. And right now, smart money is quietly shifting toward the sectors this bill just supercharged. Institutional investors, hedge funds, pension managers, and billion-dollar family offices are making moves that aren't obvious unless you know where to look. One of the clearest signals? Recent 13F filings. We're seeing increased allocations to energy giants, defense contractors, and even industrial names. ETF flow data backs it up too. Since March, dividend-focused ETFs with high exposure to energy, industrials, and defense have seen a surge in institutional inflows. It's not enough to make front-page news, but the moves are deliberate. So the question is, which ETF is set up to benefit the most? Let's start with JEPI, the JP Morgan Equity Premium Income ETF. On the surface, JEPI looks like a winner. It's got a high yield, pays monthly, and has a reputation for stability. That's appealing to anyone chasing steady income. But when you step back and look at it through the lens of the 2025 tax bill, some cracks start to show. First, the performance. Over the past year, JEPI has returned just 2.18% and only 5.21% over 5 years. Compared to SCHD or VYM, that's sluggish. This underperformance is partly due to its strategy. It generates income by selling covered calls, not from dividend growth or capital appreciation. That strategy works best in sideways or volatile markets, but the tax bill is pushing the market into a long-term directional trend, one JEPI isn't built to ride. Its sector breakdown is also misaligned with policy tailwinds. JEPI has just 2.73% in energy, a sector that's expected to thrive under the new tax incentives. It's also light on industrials and lacks the deep exposure to dividend growth leaders in financials and defense. Instead, its top holdings are mostly mega-cap tech and consumer brands like Meta, Microsoft, Oracle, and Nvidia. These are strong companies, but they're not the ones most levered to the post-tax bill boom. And then there's the way the fund is structured. JEPI owns 127 different companies, but only about 16% of its assets sit in its top 10 holdings. That's a sign of very broad diversification, which can help smooth out volatility, but it also means any high conviction bets get diluted. When the market is shifting hard in favor of certain sectors, spreading yourself thin can slow you down. JEPI's 8.65% yield is tempting, and for short-term income seekers, it has a role. But in this new sector-specific investing environment, JEPI is more of a placeholder than a powerhouse. That's why it is likely not to get the new bill perks. In the end, I'll show you and Josh the ETF most benefiting from the bill and how it could turn a $7 daily investment into a $1 million portfolio and pay over $7,000 per month in dividend income. Next up is DGRO, the iShares Core Dividend Growth ETF. This is the classic safe pick. It's low cost, widely held, and built on a disciplined dividend growth strategy that favors long-term stability over flash. Over the past 10 years, it's returned an impressive 146.58%. Over 5 years, it's grown by 63.4%. And in the last year alone, it's up 12.21%. These are strong numbers, but in the current market, where tax policy is accelerating certain sectors, strong might not be strong enough. DGRO's dividend yield sits at 2.21% with a trailing 12-month dividend rate of $1.42. Dividends are paid quarterly, and its growth is healthy, but not aggressive. What's holding DGRO back is its broad, balanced exposure. It's trying to cover everything, and in doing so, it misses the opportunity to concentrate on the areas now benefiting the most from the new tax laws, like industrials and energy. Its sector exposure tells the story: 20.02% financials, 19.09% tech, 16.52% healthcare, 11.35% consumer defensive. Industrial and energy, just 10.6% and 5.33% respectively. Real estate and utilities are almost 7% combined. These are not the weightings of an ETF positioned to surge from capital expenditure tax breaks or depreciation incentives. The top 10 holdings are familiar giants: Microsoft, JP Morgan, Johnson & Johnson, Exxon, Broadcom, Apple, AbbVie, Home Depot, Procter & Gamble, and Merck. Together, they make up 27.45% of the fund. These are quality companies, but most of them are mature and not significantly leveraged to new industrial growth or infrastructure expansion. That means less upside from the current macro tailwinds. In this policy-driven environment, DGRO doesn't do anything wrong, but it doesn't do enough right either. Reliable, yes. Optimized, not quite. That means it might not be the Goldmine ETF you're looking for. Next up is the Vanguard High Dividend Yield Index Fund ETF share. With a ticker symbol of VYM, this is the definition of solid. It's diversified, cheap to own, and performs consistently. With $75.6 billion in assets under management, it's a heavyweight in high dividend investing. Over the past year, it's returned 14.05%, followed by 63.57% over 5 years and 97.75% over 10 years. These aren't jaw-dropping gains, but they are undeniably dependable. Its 2.65% yield and $3.53 dividend rate come with quarterly payouts, and it has an ultra-low expense ratio of just 0.06%. That means more money stays invested instead of going to fees. Investors love that efficiency. Meanwhile, VYM's top holdings read like a checklist of blue-chip giants: Broadcom, JP Morgan Chase, ExxonMobil, Walmart, and Procter & Gamble. It holds 585 total stocks, with 25.42% of assets concentrated in its top 10 names. That's tight enough for conviction, but broad enough for stability. Looking at sectors, financials lead at 21.65%, followed by tech at 15.96%, healthcare at 12.49%, and energy at 8.31%. Utilities and real estate sit lower at 5.85% and 0.02%, which matters when evaluating VYM in this new tax-optimized world. So how does VYM benefit from the new tax law? Modestly. Its exposure to energy, 8.31%, and big banks like JP Morgan positions it to capture some upside, but its relatively muted exposure to industrials and heavy allocation to other sectors limit its breakout potential. It doesn't quite align with the sectors most favored by the new policies. That's why it lands at the number 2 spot. It's a rock-solid ETF, the kind you want in your core portfolio, but in a sector-specific, policy-driven environment, solid isn't quite enough to win. Now let's see how SCHD, the Schwab US Dividend Equity ETF, handles the new bill. With $69.32 billion in assets and a razor-thin 0.06% expense ratio, this ETF is lean, efficient, and built to deliver both income and growth. Now, in a volatile year, SCHD has held firm, returning 44.06% over 5 years and a solid plus 107% across the last decade. Its top holdings are powerhouses of dividend consistency and financial strength: Chevron, ConocoPhillips, PepsiCo, Cisco, AbbVie, Altria, Amgen, Merck, Home Depot, and Verizon, collectively making up 41.25% of the fund. It's concentrated, and that's intentional. SCHD favors quality over quantity, investing only in high-quality companies with consistent cash flow, strong return on equity, and a solid history of paying and growing dividends. Sector-wise, it's stacked exactly where the new bill is sending the most momentum. The 2025 Big Beautiful Bill directs money and tax breaks towards specific industries, and SCHD is heavily weighted in those areas. Energy gets deregulation, faster permits, and new tax incentives. In March, SCHD nearly doubled its energy exposure from about 12% to roughly 20%, making it the largest sector in the fund. Top holdings like Chevron and ConocoPhillips can expand production, secure long-term contracts, and push higher profits into dividends. Industrials benefit from expanded expensing limits and 100% bonus depreciation, which allow immediate write-offs for major upgrades and expansions. SCHD holds about 10% in industrial leaders positioned to gain from this investment cycle. Defense spending increases also feed into several SCHD holdings tied to military contracts through industrial and tech operations. Over 1/3 of the portfolio is in consumer defensive and healthcare, providing steady dividend growth regardless of market conditions. SCHD avoids utilities and real estate almost entirely, steering clear of sectors unlikely to benefit from the new policy. In this post-tax reform market, where sector exposure and domestic strength drive returns, SCHD is positioned to take full advantage. Its focused methodology, powerful sector tilt, and rock-solid dividend credentials make it not only the best-performing ETF in this list, but also the one best aligned with where markets are headed next. Now that we've found our gold mine, the next question is simple. How much could SCHD actually return over the next 10, 20, or 30 years if Josh invests just $7 a day? SCHD's current numbers are strong: a 3.89% dividend yield, 10.77% average dividend growth over the last decade, and 10.77% annual share price appreciation. Which, seeing how it ended up on the good side of the Big Beautiful Bill, is solid to say it will likely be able to maintain these metrics. If you contribute $7 into SCHD every day, by the end of the first year, you would have invested $2,555. This sets the stage for future growth. By year 10, the account will grow to around $45,000, generating about $2,000 a year in dividends. This growth is still relatively modest, but it lays the foundation for significant acceleration later. By year 20, your portfolio will grow substantially to about $214,000, and your dividend income will be roughly $13,000 annually. The most dramatic growth happens between the years 20 and 30. By the end of year 30, your portfolio reaches approximately $1,004,000 and your dividend income reaches $84,000 per year. That's nearly $7,000 per month. This level of passive income could support or even replace a full-time salary, marking a transition to financial independence. Want to see how just $10 a day can grow into a $1 million portfolio and pay you over $17,000 a month in dividends? Click the video on the screen.